Hi everyone, hope you are fine and is getting well with Mr. Market, because lately it has been very frustrating. It has not bottomed out yet, and one day it is all the way up, one day is down, another day is up again. So it is very frustrating for all of us. So this short presentation, what I'm going to show you is that how we can actually navigate the market, either using stocks or using option strategy, and how I did manage to have quite a good win rate around 84%, right, with 400 Robux with various option strategy, and how I did a put spread, right, and gain a profit of more than $800 in 2 days. So hopefully these presentations will find you and give you more motivation if you have lost in the stock market. So first off, we will look at the overall indexes, the Dow Jones, the SPX 500, and the Nasdaq first, and have a appreciation of the market situations before we go into the market analysis. And after doing that, I'll be sharing with you probably 5, 6, 7 to 8 stocks for the option strategy, which has garnered in 6 straight days $411, and that actually represents about 80% win rate. Okay, so but if you do not understand technical analysis and you have studied before, probably you would like to revise it if you do not understand technical analysis, and then you will then appreciate and understand the example which I will show you later. So let's go into the so this is the Dow Jones Index. I'm using the ETF DIA. Okay, so quickly let's take a look at the lowest point. The worst case, it was at -17, still not in the bear market for Dow Jones. Today it is around 10.5%. So as you can see, right, it bottoms out, and then it was followed by a few days, 5 or 6 days of green candle upwards, and now it's hovering around here. Okay, it actually crossed the 20 EMA. So as you can see, 20 EMA is slightly going upwards, right? Slightly going upwards this way, right? Slightly going upwards this way, and it is hovering here. Looking at the MACD and the stochastic, all right, stochastic show you that it is above the 80%, right? Okay, so let's go to the next index, which is the SPY. Okay, SPY almost similar, but SPY was touching the bear market, but it managed to go back up again here, right? So it didn't hit the bear market territory. It's still in the correction territory, nearly reaching the bear market on 20th of May. Okay, so today is hovering here again, quite similar to the DIA index, ETF index, which is above the 20 EMA. So lastly, let's look at QQQ, which represent the Nasdaq. So this is the worst off, because it is still in the worst case was 31%, and today, right, the worst case 31%, and today is the most is nearing the 25%. So it is still in the bear market for Nasdaq. Again, similarly, this is above and hovering on the 20 EMA. So with these indexes analyzed, right, one can realize that even though you hit a bull call here, a long bull call, more than 270 days, you would have lost in the market, all right, because today is here. All right, if you hold it, you will lost, because, and more so, you lost more because, remember, of the decaying effect. All right, so from here, December, all right, let's take December. Or okay, from here, you're buying it in January until now, today is June. is about 6 months. So you lost 6 times 3, which is 180 days, around 200 days of decaying. You buy 270 days, 200 days you're left, you only 70 days, so you're bound to lose. All right, you're lost in a loss position for the long call. Okay, so it is not advisable to buy a very long call, in my opinion, when it is in a downtrend, because everything is a downtrend here. You can see the color, the green, the yellow, and the purple and the red are all in the downtrend. Okay, so with this, let's go into my PowerPoint slide again. Okay, so this is my weekly journal for my option strategy. Okay, so I record down, you know, what I trade every day, what are the winning trades and what are the losing trades. So for example, what I have done is that I tracked down, as you can see, from 9th of March. This is a Wednesday, Thursday, Friday, over the weekend, Monday, Tuesday, and Wednesday. All right, so some of the days I only do 2 trades, some of the day 1 trade, 2 trades here, this one 3 trades, 1 trade. March I do 3 trades, 15th of March I do 1 trade, 16th of March 3 trades. So altogether we add up all the trades. All right, there are 13 trades, and out of the 13 trades, there are 11 green ones and 2 red ones. So 11 win and 2 loss, and number of trading days is 6 days, because it's 9th of March, 1, 2, 3, 4, 5, and 6 days. Okay, so the win rate, if you can calculate, is that the win rate is 11 win over 13 trades, is around 85%, and the total profit, if you add up all this, it amounts to $411. So now these trades are shorter trades than the 270 days, but one must remember, when you have to be very conversant in doing short trades, because as you can see, I'm only doing from here. As you can see, this is sell, means sell call for JPM 140, and I realized a profit of $13. Okay, sorry, yeah, I realized a profit of $13 for sell call 142. Okay, for sell call 145, strike price 145, profit only $15. Now I need very little profit because these are day profits. That means I probably did the trade at 10 o'clock, probably, or 9:45 in the evening, and I will just close it off before the market close. Maybe at 1 a.m., right? Maybe at 3 o'clock if I stay long in the market before it closes. So 1 or 2 days or swing trade less than a week. So all these trades are very short swing trades, and all these trades I have put stop loss on it. And with the stop loss, there's a risk to market ratio, probably is a 1:1 or 1 to 15% or 1 to 20%. So that's how I do it. Now, so sell call is when I anticipate, you know, when the market will drop. Sell put when the market is up, and buy call when it's up. So you must know, right? When you do a sell call, is when the market, like yesterday, all right? Yeah, yesterday the market was up. The Dow Jones index is 300 points up. The Nasdaq is also 300 points. The SPY index is more than 78 points up. So in anticipate for the market tomorrow, you do a sell call today, right? Better it is nearing the close, maybe at 3:30 or even better at 4 o'clock, right? So you can do that. For sell put is the other way around. Like today, the market is all the way down, right? Because the market is 1 week, 1 day up, 1 day down, but you won't know. So your sell put, all right, your sell put, if you are more conservative, right? Or should I say is that it is better to avoid more risk. You should do a sell put, which is 30 days, the same thing, 30 days, and you do it on 2 stocks, right? And then you break the profit. Buy call, again, short buy call with stop loss. Okay, stop loss, no emotion. After you place a trade, there's a stop loss, there's a target profit, you go to stick. All right, or you close off the positions if there's profit that you see, is just great. Okay, so for example, as you see here, $10, close it. $20, close it. This one, good one, $119, I close it. Okay, SE, even though I sell put at 88, but there's a stop loss, I close it with a negative 66. Okay. Wells Fargo, I think I have more confidence. I'll multiply by 2. All right. So I get $118. Baba, again, I sell call. All right. The market goes up against me, I lose $38. So this is how you do it. And you must be very confident and confident in doing so. So practice, practice and practice. If you're not confident, practice on a simulated trades until you have confidence to do it. All right. So this is for my weekly journal. Now, what happened for the, okay, as I can see, just now I mentioned about risk-reward ratios. Now I'm going to do, explain a little bit more. Now, for example, here, Micron, right? Sell Micron. This is in a single day. Not too bad because in a single day, I have garnered about $250, right? 171 plus 77 is, yeah, 248, right? Around $250 for a single night. So which is not too bad. And what I did was a sell call, right? I predicted MU will go down after actually it spikes up, right? It spikes up the previous day, so I predicted that it will go down. So when I do it, I always, if you can see here, this is in Interactive Broker. I always do a stop loss, and I always do a profit target. All right, always. Once you enter the trade, you always do that, and you can go to sleep. So when it touches your stop loss, you lose money. When it hits your profit, you're happier. The next day, if you look at it, if you hit the profit, probably is that maybe $8. If you're happy, you just take the reward, or you wait until 8.6. Because the market fluctuates so fast, right, in a single day, sometimes you rather take profit off the table. Okay. Now, same thing here with a sell call. This is for 75 sell call. This is for 72.5 sell call, right? You place the stop loss and you put the profit target. And what happens here, right? Sell 75. What I did here was that, okay, so I sell a call for 868. I buy it back for 695. So it's around 170 bucks. 170 bucks I earn. The same thing here. The same thing here for 72.5. Sell call. Sell call, I take the money, $595. I pay back $515. I earn $79. My stop loss is 25 bucks. My profit is $79. So it's a 1 risk to a 3 reward. So $1 to $3 reward. This is $85 loss, 177, 170 dollars win. So it's a 1, it's a 2. So this is how you do it. Okay. But once you put a sell call, all right, you don't let it run naked. You do a stop loss. Because why? You don't have 100 stock. If you have 100 stock, you do a sell call. Well, you have 100 stocks to, you know, as a backup. Okay, here you don't have, so you've got to put a stop loss. All right. So this is how it goes. Next. Okay, next you can do vertical spreads. Here I'll do a bull put spread, which I anticipate the QQQ, right? The Nasdaq ETF will go up when it hits near the bottom, right? It hits the bottom here, it goes up again, then it goes to the bottom, which is on 24th of May that I execute this. Okay, I execute a sell put and a buy put. It's a vertical spread. And then I release it 2 days later, which is over here. Nearly the $300, 299.63. All right, I bought it at around 286. I bought it around 286. I released when the strike price around 300, right? I could have waited for more at 305, which is the first profit taker, and then more greedy, 322. Okay, but I don't want. Okay, $800 is enough for me for 2 days, 826. So I closed the position. So as you can see here, right? So 1,300 minus the buy put, I have a profit of 800 of $26 realized profit. So this is how you can do it even in a vertical bull put spread or a bear cross spread. So everyone, in summary, okay, let me sum up. Okay, for me, in my opinion, it is not a time to buy long calls until the market turns bullish, right? You can capture profit with shorter swing trades. Swing trades means 1 week or 2 week or 3 weeks, right? Utilize your technical analysis knowledge. Okay, so if you forget, practice again, go through the videos. Number 3, right? This is where fundamental analysis is very, very important, right? You know how to find good business, great stock with positive, solid cash flow, zero debt, and undervalued companies, okay, from the cost. So just do it, okay? Gather about 10 stocks, okay? When it goes down, buy in trenches, okay? Buy in trenches so that when the market goes bull run, you'll be laughing, all right? So wait for the next bull run, and good luck and happy investing. And all right, so I will sign out here. This is Charlie Wong from Investing for Wealth and Happiness. Good luck to you. Now, for those who have who likes this video, please share it out, and also please feedback whether this video is too chim for you, too difficult to understand. Well, maybe you do not understand sell-put. You want me to go slower, or it is too easy for you. You want me to do more advanced option strategies, to comment, right? So comment and everything, so I can do the next video, which will cater more to the people that needs it more. So I'll see you again.